You've seen your way through 4 crises. You've seen your way through the savings and loan crisis, 2008. I'm wondering how you believe this current crisis really compares to what you saw back in 2008.
Well, thanks, Sonali. First and foremost, I hope you and your family are safe and healthy. We have a very large office in New York, and we're monitoring the situation there closely. So all 4 crises have had very different precipitating events, but each revealed excesses in certain areas of the economy. The 1990 crisis was precipitated by S&L excesses, which was a function of lax lending standards and asset liability mismatches. 2001 followed the bursting of the dot-com bubble, and there were massive defaults in the highly leveraged telecom and cable sectors flowing from the internet hype there. We saw over 6% unemployment and almost 3 million jobs lost. 2008-09 was a different animal. It was the result of a bank-driven liquidity crisis, which was the outgrowth of ridiculously leveraged global financial system. Here, unemployment spiked to 10%, and nearly 9 million jobs were lost. 1990 and 2001 were relatively short-lived, although still devastating to certain sectors of the economy. But they weren't the great global financial crisis that we experienced in 2008 and 09.
So
this time around, the recession has been precipitated by a global pandemic coupled with an oil price shock, which revealed excesses in corporate credit and direct lending. I can put some numbers around that. Right now, at the end of February, there was $2.7 trillion of total leveraged debt, high-yield bonds and leveraged loans outstanding. That's double what we saw in 09. Firstly, net leverage was 4.2 times as of the end of the year, which is the highest on record. And then we have the whole category of BBB rated debt, which has spiked materially. Last year alone, 54% of investment grade issue was BBB.
I want to stop you.
And that's.
I want to stop you right there.
And there's a concern there, of course, where with those getting downgraded and the impacts on the corporate bond market based on that.
Well, if you're saying now that what is done, and this is what I took out of that a lot of the system was highly levered even before a lot of the coronavirus issues had come to the fore, what happens next with such an over-levered system?
Well, unfortunately, what will happen is likely a spike in defaults. Now, it's a strange situation this time around because there's a sense with respect to the disruption of businesses that perhaps lenders will be willing to work with companies more than they have in the past, given the almost cessation of business caused by the pandemic. Obviously, this is an incredibly challenging dynamic of the recommendations of the medical community, which are very necessary, are contributing to the destruction of our real economy. And so here, in some ways, it's much more severe than we experienced in 08 and 09. And you saw that in the incredible volatility and revenue destruction we saw, which will lead to cash flow destruction, liquidity destruction, and knock-on effects to all the stakeholders who are in the universe surrounding these companies.
So then you were mentioning you'll see a lot of defaults here and bankruptcies, already seeing some come in the energy sector, hospitals. What is your biggest expectation for bankruptcies moving forward?
Well, look, the retail and energy sectors were already under substantial secular and cyclical pressure before the pandemic, so they were under trouble. Obviously, with the price war and the limitation on travel, oil has suffered tremendously. But anything really related to consumers, airlines, hospitality, gaming, cruise ships, fitness, movie theaters, consumer discretionary, Yeah, the bigger question is what sectors aren't negatively affected by this, because this is really historic, and hopefully we can get through the worst of it with this really staggering stimulus policy that's been put in place by the government. Really, if you look at the last 20 days, it's really incredible what has been done on the monetary and fiscal side.